Welcome back to the Deep Dive, your shortcut to being genuinely well-informed. We try to pack in surprising facts and hopefully just enough humor to keep you hooked. Today, we're taking a deep dive into something that feels, well, pretty transformative. Strategic cash flow investing. It honestly feels like unlocking a whole new level in your financial thinking. Our mission today, to really distill the core insights from our sources, helping you understand how to generate, consistent, ongoing income through your investments, not just waiting for them to grow someday.
Exactly. And our main source, strategic cash flow investing, it really sets the stage for that. It's not just a how-to guide. It's almost like a re-education on how you view money.
Yeah.
So our goal is to pull out those really crucial nuggets of knowledge, help you navigate the different investment paths with a bit more clarity and purpose. We're trying to look beyond just the surface to understand not just what these paths are, but why they're so fundamental if you want to build a reliable income stream.
That's a really powerful distinction, actually, because, for so many of us, the default advice is always just save, 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 pile it up. But the source kind of pushes back on that being the only strategy, right? So let's get right into it. What's the fundamental shift? The mindset change the source talks about when we move from just saving to actively investing for cash flow.
Well, a key insight, I think, is that saving, while it's important, for emergencies and stuff, it also just leaves your money sitting there, idle,
Yeah.
losing value to inflation, right? Cash flow investing, though, it turns your capital into an active player. It's about putting your money to work strategically to generate regular, predictable income streams now, not just waiting for assets to appreciate way down the line. Think of it like turning your money from a trophy on the shelf into a farmhand who's constantly bringing in the harvest.
Oh, I like that analogy, a farmhand. Yeah, making your money work for you, not just for some future version of you. Okay, let's unpack this then, starting with a strategy that probably feels familiar to a lot of people, real estate. And the source is super clear here. We're not just talking about buying a house and hoping its value goes up in 10 or 20 years. I mean, that's nice if it happens, a bonus, but it's not the core idea here.
Precisely. Yeah, the critical difference the source makes is between just hoping for appreciation versus actively generating income. It advocates buying properties specifically because they produce consistent rental income. So the property becomes an asset that's actually paying you, every single month. It's not just about owning property. It's about being an investor whose asset throws off surplus cash after all the bills are paid.
And they get surprisingly specific about what that rent has to cover for it to be a good cash flow investment. It's not just the obvious stuff like the mortgage payment, property taxes, insurance. It really emphasizes factoring in repairs, obviously, but also something maybe newer investors miss, the property manager's fees, even if you think you'll manage it yourself at first. And maybe more importantly, it highlights a trap, underestimating how often the property might be empty. Vacancy rates.
Oh, that's absolutely vital. The source suggests you should factor in a minimum of 5 to 10% vacancy, even if it's a great property, because just a month or two without a tenant, that directly hits your cash flow projections. Understanding these often overlooked costs, like that vacancy buffer or setting aside money for maintenance, is fundamental. It directly impacts your net profit. If the rent doesn't comfortably cover all that and still leave a decent chunk of cash, it might not be a true cash flow positive investment, at least by the source's definition.
Right. And this is where it gets really interesting, I thought. The source gives this very concrete, actionable target. Aim for 7% or more cash-on-cash return. So just to break that down for you listening, the source emphasizes this is your annual cash flow before taxes measured against the total actual cash you put into the deal. Your down payment, closing costs, initial repairs, etc. It's like the key number for understanding how hard your actual invested cash is working to bring in more cash.
It really is. That 7% cash-on-cash return, it's not just some arbitrary number. It represents a pretty significant, consistent stream of income flowing back to you year after year. It makes the property truly productive. It's generating income actively, not just sitting there hoping to appreciate on paper. It's all about how much actual cash hits your bank account relative to the actual cash you put in.
Okay, so real estate's one path, but maybe that's not your only interest, or you want to diversify where that income's coming from. The source then pivots to another really powerful area for cash flow, the world of businesses. And it presents two kind of distinct ways you could approach this, either rolling up your sleeves and running your own show, or investing in businesses run by other people. So let's take the first one. If you're maybe thinking about entrepreneurship, what does this mean for you? The source points out, look, by running your own business, you're not just creating a job for yourself, you're building an asset that can potentially generate way more income than a typical salary, plus you're in control. You get to steer the ship right.
Absolutely. And beyond just the potential for higher earnings and, being the boss, the source highlights a really practical benefit. It's about how you structure your business expenses. Things like your home office, maybe some software you need, even part of your phone bill. When these are legitimate business expenses, they directly boost your net cash flow. It's not just about a tax deduction at the end of the year. It's about classifying costs in a way that enhances your profit. It's kind of a subtle but powerful lever, turning potential personal expenses into business advantages that help your cash flow.
Okay, but maybe running your own business sounds like a lot. Too hands-on for some people right now. So the source also talks about a less intensive way to get cash flow from businesses, investing in ones other people run. This is where you can still benefit from all that business activity and get regular income, but without, being responsible for the day-to-day operations.
Yeah. Exactly. And the source details two main ways to do this. First, buying stocks in companies that pay dividends. And dividends, as the source explains, are basically a share of the company's profits paid out directly to you, the shareholder. Usually happens quarterly. It's just cash landing in your account. The second way is investing in exchange-traded funds, ETFs. These often hold a whole basket of different stocks, many of which might pay dividends. ETFs are interesting, as the source points out, because you can trade them easily, like stocks, but they give you instant diversification. You can even find ETFs specifically designed to hold lots of high dividend stocks, so you get broad exposure to income streams without picking individual companies. The nice part, like you said, is you don't have to run anything. You just invest and hopefully get paid.
That's already pretty appealing, right? Passive income. But then the source adds this strategic tip that can really accelerate things. It's the simple but actually profound idea of reinvesting your dividends. So instead of just taking that cash when it comes in, you use it to automatically buy more shares of the same stock or ETF. This means your next dividend payment will be slightly bigger because you own more shares. It creates this compounding effect, like a snowball rolling downhill, getting bigger and faster over time. It really supercharges growth. Okay, so we've got real estate, we've got businesses, but why stop at your own country's borders? This deep dive encourages us to think bigger, and that brings us to the idea of investing around the world. Global investing, it's not just about what's happening, down the street anymore. It's about casting a wider net.
Yeah, and connecting this to the bigger picture, diversifying geographically, it can offer real resilience and open up completely new growth opportunities. The source highlights that looking globally isn't just about general diversification because it sounds good. It's about maybe finding markets where dividend yields are historically higher. This could be due to different corporate cultures or economic cycles. Some developed markets really value consistent dividend payouts, while maybe some emerging markets offer potentially higher, though definitely riskier, growth and income opportunities. It's about not having all your eggs in one national basket, yes, but also strategically looking for environments that favor cash flow.
That makes sense, broadening the horizon. But thinking about the cash flow investor specifically, are there particular risks with global investing? Like, I don't know, currency swings or political stuff, things the source warns about if you're aiming for consistent income.
Oh, absolutely. The source definitely acknowledges those risks. It points out that currency fluctuations can seriously impact the value of your income when you bring it back home. And yeah, political instability in some places can add a lot of volatility. Unpredictability isn't great for consistent cash flow. So the recommendation is often to maybe invest through larger diversified global funds. They can help smooth out some of those single country risks. Or if you do go direct, really research countries with stable economies and strong legal protections for investors. It's about being global, but smart and cautious about it.
Okay, caution is key there. But what about those investments that seem really exciting? The ones promising huge returns, but maybe feel a bit dicey. The source has a very clear, almost stern warning about this category. It calls them speculative investments.
It does. It's quite prescriptive, actually. It basically advises you to start with 0% in these. Zero. And only consider adding to them later, slowly, once your other, more stable cash flow investments are doing well and growing. This really raises that important question, doesn't it? How do you balance the excitement of maybe hitting a home run with a calculated, sensible approach to risk? These aren't where you build your foundation. They're maybe, possibly, where you accelerate things later on, but only with money you can genuinely afford to lose entirely.
And the source gives some pretty clear examples of what fits this description. There's crypto, Bitcoin, others which it notes can shoot up but also plummet incredibly fast, a real roller coaster. Then startups, new companies with big dreams but super high risk because frankly most don't make it. And finally, collectibles. Things like rare trading cards, vintage watches, art, stuff like that. They might go up in value, but there's zero guarantee, and trying to sell them quickly if you need cash, that can be really tough. Liquidity issues.
Yeah, and it's crucial to understand why these are labeled speculative, especially for a cash flow investor. It's mainly because they rarely, if ever, generate consistent cash flow themselves. Their value is almost entirely based on what someone else might pay for them in the future market sentiment, basically, which is super volatile. The prudent approach, stressed by the source, is to first secure your financial base with reliable income streams before even thinking about these high-risk plays. They're not primary wealth builders. They're potential enhancers, maybe, for an already strong portfolio, and even then you tread very, very carefully with just a small part of your capital.
Okay, so be careful there. Finally, let's turn to what the source calls the most important investment of all. And this isn't about buying a stock or a building. It's something much more fundamental. It underpins everything else we've talked about. It's investing in your education, specifically your financial mindset.
Right. This is fascinating. The source reveals just how profoundly our basic beliefs about money can shape our financial future. It calls this level 1, mindset. And it directly contrasts that common societal message most of us get. Save money, just save it. Contrast that with the powerful insight that actually real wealth is built by investing. It's really a call to fundamentally shift how you think about money. Stop seeing it just as something to hoard or protect, but as an active tool, like a seed you plant to grow more resources.
So what does this really mean for you, listening right now? It's about a complete paradigm shift, isn't it, in how you approach your whole financial future. It's understanding that, yeah, saving has its place, short-term goals, emergencies, absolutely, but true, sustainable wealth, that consistent income we've been talking about, that comes from actively putting your resources to work in smart, strategic ways that generate more. It's an investment in understanding the rules of the game, really, and constantly learning how to play it better. So, quite a journey today. We've taken a deep dive into strategic cash flow investing and looked at a whole range of avenues. We talked about income generating real estate, hitting that 7% cash on cash goal, watching out for hidden costs like vacancy. Then we moved to businesses, the power of owning your own, the cash flow boost from write offs, or the simpler income from dividends and ETFs. We also touched on going global for diversification and opportunity, and importantly, that very cautious stance on speculative stuff.
And throughout it all, we kept coming back to that core idea, right? The power of your mindset and just continuous learning as the real foundation for building wealth. The source makes it so clear. Knowledge, perspective, that's invaluable. Understanding how money works, how to make it work for you, and always adapting your approach based on what you learn. That's probably the most impactful investment you can ever make, period.
Absolutely. So here's a final thought to leave you with. If real wealth is truly built by investing, not just by saving, what's one small, actionable investment in your own financial education you could commit to today? Beyond just putting money aside in the bank, maybe it's reading more about one of these strategies, maybe it's just changing how you talk or think about money in your own life. We really invite you to reflect on these ideas and see how you might start applying them, turning savings into active income generators. Thanks so much for joining us on the Deep Dive.